The following is a presentation of TFNN. It is now time for the Diagnostic Trading Hour with your host, Darrell Martin. Call now, toll free at 1-877-927-6648. Internationally at 727-445-1044. Now, Darrell Martin.
Folks, welcome on back here to the Diagnostic Trading Hour right here on TFNN. I'm your host, Darrell Martin. Glad to have you today. Make sure you tune in to us each and every day at TFNN.com. Watch us on Tiger TV. 9 hours of live programming a day with live traders talking about the markets. Also, make sure to, if you're away from your computer, TFNN.mobi, and you can still listen in and catch up on what's going on. So, what's going on today? We'll look at a few different things. A couple topics. Wanted to go over just some of the different ways that you can look at deviation levels, and also wanted to go in for whatever market you're trading. And so that's going to be our big topic. We'll go into the news a little bit. It's a pretty light news week. This week is one of the lightest we've had in a while, and so of course the main news being Yellen and her, testimony and all that fun stuff. But beyond that, we only have a couple reports coming up this week. So before we dive into the deviations and everything else, let's wrap those up for you. We're going to have, looks like a straddle that we can look at for tomorrow evening. And that is going to be the Aussie employment change number. Okay, so the Aussie employment change number, and a little bit interesting stats on this one. Okay, we got 75% of the time it breaks 50 pips. That's good. I like those stats. But the average move high to low is 50 pips. So that basically tells me you go and you start adding them all up. Say that's 25% of them are at 40. Okay. And 75% of them are at, say 70. And so that brings us, to 50 or I don't know, whatever those numbers would be. That's probably not exact math. But you get the idea. Like we're just on that line of 50. So what you definitely need to make sure you do is calculate your risk, your reward, your take profit. And this is an error I've seen a few traders make. I saw a really good post by a trader the other day that he did on NFP, and he was asking me a question. He's like, hey, here's a trade I did. What did I do wrong? And he gave me all the prices and everything, and it looked like a good trade from the outset. He had about a $68 risk, and we had about a 100 pip expected move. The problem was where the market was at the time of his entry actually required about 130 pip move for him to get a 1-to-1. And so really he either, shouldn't have put on the trade. He should have looked at a different market to see if there was a better spread somewhere else. He should have looked at a strangle. He could have considered maybe inverting the trade and doing an iron condor, or he could have went in and simply just not done the trade. So it's really important that you know where those take profits are, because it's so easy to go, okay, well, hey, I'm looking at my max risk of maybe $25. But that doesn't mean that's a good trade. That's just, that's a guideline for max risk, okay? So I want to make sure I cover that topic because, like I said, that's one that's been coming up a lot. And I also want to go into the deviation levels because I know some people have had questions about combining deviations with volume and putting a couple of those pieces together. And just, a little bit topical focus today versus just general market information. So I guess we'll start off, since I already am on the topic of the news thing. It's not a heavy news week, but it's a good week for you to learn it. And one of the best suggestions, and this wasn't even in mine, this was one of another trader that I know. He was talking and he's like, hey, one of the things that he's done and that he's recommended that other people do, which I thought was a really good idea, is he says don't wait till the news to do a news trade. And it sounds funny, okay? But what he was saying there was go in and practice these straddles. Practice what a 1-to-1 is. Practice the math. You don't have to wait until you only have 15 minutes to put the trade in to to hammer it down. I mean, you could do these every single hour and just, get your math down, okay? So what I want to do is first make sure you understand how to actually calculate a 1-to-1 on a straddle. And we're doing straddles. One of the cool things on Nadex, I mean, yeah, you can go and you can do straddles, strangles, verticals, all that stuff on the regular options market, but you can only do it like on a weekly time frame at best, maybe monthly, depending upon, or maybe not at all, depending upon what, contract you're trading. So let's go in and let's look at how this actually works out, okay? Right here, let's pick, and a lot of times we're doing currency. So, we'll just pick, I don't know, maybe we'll try the U.S. yen. We're going to find something that hasn't just totally blown out of every single thing. Let's see if we can find something that's a little more ideal for the teaching scenario. And we got this so much movement today. Here we go. This is good. Pound dollar. Okay. So, let's say I'm doing a trade on pound dollar. And I'm going to go in here. I'm looking at this. And I got to pick my spread. Okay. And when I look at all the different spreads, I got 2 o'clocks and 3 o'clocks. That's the first thing I want to notice. More time, less time. Well, I can tell you right now, I'm not going to be doing, for a straddle, I'm not going to be picking that spread. Why would I not pick that spread right there? I'm looking at a spread that literally is basically the market, which is what this shaded price is right in the middle of the floor and the ceiling. That's trying to do a straddle with a call and a put where, they're crossing over each other. See, be sort of like picking this right here. And that's not even the best example. I could probably find a better one. But, anyways, you get the idea. You want it to be near the floor or ceiling. You want a really low risk on that trade because you're trying to make money if it goes down on the short one, if it goes up on the bot one, and you need the other one to stop losing so you can do so. All right. So if we put those pieces together, pardon me, then what we're going to find is that we need a lower risk trade. So we know the 2 o'clock's out. Over here you could potentially want the 2 o'clock. It depends on that. So that's possible, but definitely not that one. If I know I don't want that one, I know I don't want this $73 one, I can even lower my risk more. I'm going to take it down to $50. And this is a big tip on the scanner. I think a lot of people go backwards. And I understand why you go backwards, because you start at the top and you work your way down. But in reality, what you want to do is you want to pick your instrument. You want to have no filters. You want to look down here and figure out what you want to get rid of, and then use the scanner. And then what will happen is if you do that over and over, pretty quickly you'll learn what you don't want on the screen. So if I say, I don't want things that have more than $50 now, and this could be different by, what you're trading, but I go in here and say 50. Now I've got rid of, a couple of these here. It'll update in just a second. There it goes. Now I've got rid of all the trades that have more than $50 risk on them. And so that gets rid of a lot of bad choices. Now that I've done that, I'm like, okay, so I'm still trying to figure out which one it is. Which one do I want to do? Remember, I want to get as close as I can to where the live market is. Well, that 2 o'clock's really not right at the live market, so I don't like that one. What about that 2 o'clock? Is that at it? No, that's outside of it also. What about this 3 o'clock? Oh, that's right at it. Okay, so I know I don't like either one of these 2 o'clocks. Because see how the market is pretty deep in the money on this one, and it's, pretty out of the money on this one. That's why there's a $3 risk and a $15 risk. So in comparison, because one of them has real intrinsic value, one of them is just pure premium because it's out of the money. So I'm going to go, I don't want the 2 o'clocks at all. And I'd rather have more time to be right anyway. And it looks like it's not really going to cost me more for more time. That's $11 versus $16. That's 8 versus 3. So we're talking $5 more, $5 less dollars. Yeah, let's just go ahead and get rid of the 2 o'clocks. So, 2 o'clock's coming up here in 45 minutes. I can say, hey, I want to make sure there's at least 60 minutes till expiration. Now, remember when you do this, you're ruling things out. So if you come up and it's, 3 o'clock and that's all there is for spreads, you won't see the 3 o'clocks, at 2:01 because you said don't show me anything that doesn't have at least 60 minutes. Just remember that you put that filter in there. But if you ever forget if something's not showing up, just hit reset filters. Real simple. So now we go down here. Now we only have what's available. Well, I can also see if I look at this. See these yellow and green ones? So the colors sort of help you on this. They're not really straddling it really well. They started at 7 a.m. The 3 o'clock one started at 1 o'clock. So that's why they're closer to the market price. The market, just, the way it's moved. So really not into those. And so the best choice, period. Unless I'm expecting just a massive move of more than, like 140 pips, okay? Which I don't think there's going to be any news announcement where I'm expecting more than that. Unless I'm expecting more than 140 pips, that is perfectly acceptable range for me on the pound dollar. So that is my best spread. It gives me the most time. It is closest to the market price, okay? It has the best, risk-reward total combination. So in every way, it is the best spread. And I didn't do any math. I just looked at the numbers. 29 plus 3. Well, that's 32. I did some math. I added 29 and 3. But 29 and 3 were done for me, versus if I was over on Nadex, I would have had to either open a ticket to do that, or I would have had to do it in my head to even figure out what the risk was on the trade. And then I'd have to compare them against all the other ones, where this is doing it for me simultaneously. Okay, so now that I know that's my best spread, now I need to know what my 1-to-1 is. And this really gets people, they think they got it, but there's one piece that I'm starting to see that people will sort of consistently miss. Okay? So let's look at that crucial piece. Go over here. I'm going to put a little Excel, and I recommend that you start learning how to use Excel. Get openoffice.org. It's free if you don't have it, okay? Or, get Microsoft Office. Now you can lease it for like $30 or $50 a year. I don't know, whatever it is. But anyways, you need to get Excel if you're a trader. So we'll get over here. All right, so I have basically, I'm not including the 90 cents. That's my fees. I don't worry about 1-to-1 on fees. If my trade comes down to fees, I need to be going for more money. But and the reason I say that is because I've had the experience of losing a trade because I was waiting for $2 more to cover my fees, and then I ended up losing hundreds of dollars because I wanted $2 more. So fees to me, I'd rather pay the fees. But if you want to add them in, you can if it's worth the risk to you. But let's calculate your risk just without the fees. So basically what we're doing is we're adding in 90 cents on the loss side to the fee. Because that's the fee on Nadex is 90 cents a contract, but it stops at 10 contracts, it's $9. So if you do 100 contracts, it's only $9. So it gets progressively smaller. Okay? So right over here, because it flattens out at $9. So we got an $8 risk and we got an $11 risk. So our total risk on the trade is 8 plus 11. So $19. That is our total risk. All right, that's pretty easy to get down. Most people get that. So to make a 1-to-1, and we'll put $8 on the long, $11 on the short. Okay, so we'll talk about the 1-to-1 on each side, and the piece that I'm finding that people often miss on this when we get back from this break.
Who says you can't take it with you? TFNN says you can. With your mobile device and TFNN's live radio streams, TFNN has put it all in the palm of your hands. No special apps to download. No subscription fees for live radio or Tiger TV streams. We say you can.
Now let's go over to the dollar, because the dollar is going to be the generator. It is the generator of basically higher dollar, lower market. And what the dollar has done, and this whole uptrend, folks, has just gone sideways. The way it works, folks, is this.
We say you can. The Tiger Financial News Network. Smart investors and professional traders know you can. TFNN.com. Educating investors. with the launch of Tiger TV. TFNN has brought our programming to the next level. With Tiger TV, you can gain access to each host's charts and computer screens as they host their daily stock program. Whether it's Tom O'Brien, Steve Rhodes, Basil Chapman, David White, Larry Pezzamento, Andy Hecht, Victor Jones, or Darrell Martin, you can catch all of our technicians hosting their programs live and archived on Tiger TV for your viewing pleasure 24 hours a day, 7 days a week. If you haven't checked out Tiger TV, then visit TFNN.com and see what you're missing.
TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartley's, ABC's, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com.
Patterns, profits, and peace of mind.
Are you looking for a precision edge in the market? Something that can stack the odds in your favor? Then look into Larry Pezzamento's trading newsletter.
Patterns, profits, and peace of mind.
In each weekly issue, Larry explains what's going to happen in the markets based on the pattern he sees developing and gives you actionable trade ideas based on those patterns. Plus, you'll get his detailed analysis on a variety of markets and sectors, including stocks, treasury bonds, the gold market, oil, the dollar, the Forex market, and more. You'll get access to all the patterns Larry is seeing in the markets, plus the Astro Harmonics and powerful Bradley stock market model that Larry utilizes for less than $5 a day. An extremely potent combination that will give you the edge you've been looking for. Try Patterns, Profits, and Peace of Mind absolutely free for 2 full weeks. That's an $85 value. Yours free when you register right now.
Get Larry's Patterns, Profits, and Peace of Mind.
And get the edge you've been looking for.
Investors, Taz Market Research delivers to its subscribers expert commentary on the analysis of 15 different markets each day. Get this invaluable and timely information through the daily market research videos Taz Market Research produces each day before 9 a.m. The video analysis will include reports on currencies, interest rates, indices, metals, energies, grains, and more. You'll be able to gauge where high profitability setups are in each of the markets. Receive a free 2-week trial subscription to Taz Market Research videos on the front page of TFNN.com. Darrell takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
All right, folks, we're coming back here to the Diagnostic Trading Hour. So just to give you a quick market update, we'll get right back on it. Looks like all the indices right now are pretty much knocking right up against one deviation at the moment. Pretty weak volume, but you know, you got to go back and find out where were they at last and what kind of volume did they have at that point to see what are they going to be pushing through. Wouldn't necessarily just go short on it. Would wait for some sort of confirmation. But at this point, you know, no volume spikes at a deviation level. They could just slowly trend up all day, or they could turn around. So right now I'm long on all the indices, but closely watching them and tightening my stops up, like I said, because we're right at the one deviation, the expected move for the day, okay? We're right at that level. And go and I'll show you the S&P real quick as well. And right there, see, so just busted through. We did get a little bit of volume spike. We were actually right in the one zone there, but see how it didn't do a reversal. This is important. Right there, I told you, remember we were talking a little about deviations. Didn't do, right there, that's the volume spike. And on 5 minutes. So we'd have to go over and flip to a 5-minute chart, but basically we didn't break down, so we didn't have a trade entry on that trade right there. Okay? All right. Well, but keep watching them and tighten up those stops. On all stops, I would have, just to let you know, on ES, if I'm long the S&P right now, I'd have my stop around 1809.25. So now I trail my stops pretty liberally. Okay, about 5 ticks below the 10-minute bar there. And let's see, I could actually have it a little bit higher. I could have it up to 1810.25 actually now. And then, yeah, I'll give you the stops on all the indices where we're at. On the Russell, I would have my stop right now. This is my trailing stop for the long trade. I'm going to have that up at 1125.6 at the moment. So that's where I have my trailing stop up on the Russell. And then on the Nasdaq, that's not necessarily a short entry, by the way. Okay, that's a trailing stop. So I need a little bit more confirmation than just hitting that price to go short. And then over on the Nasdaq, we'd be looking at around 38.0635. So a little further away on the Nasdaq there. Well, we did just hit one deviation. We haven't closed up above it is the problem. So, it hit it. It's in the zone, but it has not closed above it yet. And the others may turn before it does. We'll see. I mean, it went right just now, touched it. It was working on it. It got there. And then for the last one, for the Dow, we'll go in, and right now my trailing stop on the Dow, going long, is right up at 15,904. Okay, so that's where I'm at on the Dow. We're up at 1.5 deviations. Remember I said it don't always just stick to the one. That's the expectation. So, there is a reason that I give 1.5, 2s, and 3s, because I don't want to get out just because it hits it, because it may keep on going, and it did keep on moving. Okay, well, that gives us a quick summary there on that. Let's get back over to straddles. We're talking about pound-dollar straddles. We're talking about $8 risk on the long side and $11 risk on the short side, at least from whenever we started looking at the trade. So now we need to know, well, how much do I need to make? So on my long side, okay, so my long break-even, or not break-even, but 1-to-1. 1-to-1 profit. My short, 1-to-1 profit. Well, it's the combined risk of both sides, $19, plus the risk on the opposite side. So it'd be 19 plus 11, right? Because if it goes up, let's just say we assume the short side's going to lose. We need to make 19 plus $11. On the short one, I need to make the combined risk of both sides. Assume the long side's going to lose because the market's going to fly down. Okay? And I need to make the money back on the long side. I need to make 27 ticks. So that's how many ticks I need to make on my 1-to-1 profit. And I can go in and I can adjust this as the market's moving. That's one of the nice things about the Excel sheet. You don't have to redo stuff over and over again. And then if we go in here and I put in, okay, well, what price am I buying this at? I'm buying it at 1.6467. Okay, so this is my, bought spread. And then my sold spread, I'm going to sell it at 1.6449. So what that means is I need to make it, and this is where we start getting into that crucial piece, okay? And let's see, let me convert this into ticks. All right, we'll stay right there. So we're getting right next to, we're almost there to that crucial piece that most people miss on these news trades. Stay there, and we'll get it on the next segment right after this break.
Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock in option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com. Andy Heck's powerful weekly newsletter, the Technomental Commodity Report, has delivered multiple triple-digit winning trades in recent months. And right now's the perfect time to get a full month-long trial to Andy's newsletter with no obligation to pay anything. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Technomental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you'll lock in the low rate of only $59 a month. Sign up right now for the Technomental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com.
Darrell Martin coined the phrase diagnostic trading, and we're happy to announce that his Diagnostic Box Spread Analyzer has finally been released. The Diagnostic Box Spread Analyzer helps you easily identify the best box spreads on Nadex in seconds, plus you receive access to the diagnostic deviation levels, as well as step-by-step training videos teaching you how to trade Nadex spreads so you can quickly master the mechanics of this simple yet powerful trading instrument. By pulling live data from the Nadex exchange, the Diagnostic Box Spread Analyzer does all the math for you, calculating risk, reward potential, distance to break even for both outright spreads and spreads used to hedge the underlying market. Visit the front page of TFNN.com today to get your 2-week free trial to Darrell Martin's Diagnostic Box Spread Analyzer and gain access to the valuable information it can provide when trading the Nadex box spreads.
This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
All right, we had a question over the Tiger Den about FAZ, F-A-Z, and I just look it over real quick. It's moving its way on down right now. If it does continue to do so, it's pretty much at the highest expected range for this hour already, but we're about 25 minutes ways to go, so I would expect we're not going to have a whole lot of additional movement for the rest of the hour. But if it does continue down, my next target on it would be down to 2120 and basically I had to scroll back quite a bit until I could find a lower price, and then I went back and I found the highest volume bar I could find. So right over here, we go there. That's pretty much the high, 500,000 in 10 minutes is pretty much standard right there for high volume. So there's the last high volume bar. So that's the closest magnet price I could find is right around 2120. Looking at my next, as far as a short side target on it, it's been, of course, going. Moving on down lately quite a bit. But that would be the next place to go. All right, so covered FAZ there. Get on back here to our strangle and checking this out. We got pound dollar right now. And we're looking at, putting in all the information. We talked about $7 risk on the long side, $11 on the short side. And this is, actually, we're going to bring it down here now so you can see more what we're looking at. This is a P&L graph here at the top. Okay, so right up here, so this is, price moves up and down. This is the live market. This is your max profit or loss. So loss is down, profits up as the market rises or falls. And he knows we can make money in both directions because it's the one we bought stops losing, the one we sold starts making money, or the one that we sold stops losing, the one we bought starts making money if the price rises. So you bet there, Dr. Dan. And so going on over here and checking this out, looking at, okay, where do I have to hit that 1-to-1? So I know I need to make $29. That's pretty easy to figure out. 7 plus 11 is 18, 18 plus 7, on down the list. It's not too hard to figure out how much I need to make. But now I need to figure out, and this really isn't too hard either, okay? If I bought it and I need to make 29 pips, okay, because every pip on Nadex is worth $1. If you want it to be worth $10 or $100, just buy 10 or 100 of them. So I need to basically sell, 29 pips higher. All right, so that's my, 1-to-1 take profit, okay? And right here, if I want to sell this, I need to sell it at, 64.24. So, which is 25 pips lower. That's my short 1-to-1 profit. Well, that seems reasonable because let's say I thought my expectation on the trade, let's just say I thought it was, I'm trying to come up with a good example here. Let's say I think my expectation is 30 pips. Because this will happen quite a bit, actually. So, not that the expectation is 30 pips, but like your risk would be 30, or your risk would be 50 on a 50-pip move. So, my expectation is 30 pips. Well, if it's 30 pips and it only has to move 29 or 25, then that sounds like that will work. But, if we go over here and we go, what would that mean on the bot spread? How high would the pound dollar have to go? Well, we got the pound dollar plus we need to add in our 29 pips. And then we got the pound dollar, where it's at, minus our 25 pips. Now that would be, this is what most people look at. That's what they think. They think that they're just going to add 29 pips to where the pound's at now or subtract 25 pips out from the pound's at now. That's going to work. That is not accurate. So let's delete that out. Do not simply look at that. What I want you to look at is what is the expected move. Let's say the expected move is 30. Okay? So let's do the pound dollar and then let's add the 30 pips. And then let's look at the pound dollar price and then let's subtract the 30 pips because we expect that's how far it's going to move on this announcement or in this hour or whatever. So this is really my expected high. And this is my expected low. Now let's see. Okay. See, we're 10 ticks short. All right, and this is the problem where most traders mess up on these trades. Is they go in and they're thinking 29 pip movement on the pound, but the problem is you need the 29 pips. If you think okay, it has to move 30 pips, I only got to make 29 to be break to make 1-to-1. No, the expectation is 30 pips. It has to move 29 pips higher than where you bought the spread, not 29 pips higher than where the pound dollar is. The pound dollar itself has to move 29 pips higher than where you bought the spread. Because if I bought the spread at 64.67 and I want to make $29 on it, it needs to move 29 pips higher than that. At a minimum. I mean, that doesn't even account for bid-ask spread. So at a minimum, it's got to move up 29 pips higher. Well, I didn't buy the spread at the market because it's an option. It's like a call or put. It has a little bit of, not a lot, I mean, a couple hours of premium, but I mean, it has like, 10 pips of premium in there. So actually, it has 7 pips. But if we go in and we look at it, we do all that math work. Oh, wait a minute. Okay, so it actually has to move 29 pips higher than where I bought the spread. It has to move up to 64.96. It doesn't have to move to 64.86, 64.96. So what I'm really saying on this is there's not enough expected movement. And so what I'll do is I'll go in and go, okay, well, let's look at this. What is this movement? So I'll go, what is my take profit price? So this is the easy way to go backwards. So now that I've went into the complex way, let me go back to the easy way. Once you figure out that one-to-one, which really is not hard. Most people can go in, $29 I need to make, $25 I need to make, sell 29 pips higher, buy back 25 pips lower. The easy way now is go, okay, let's take that, 64.96, and let's just subtract it from where the market is. And let's take this price and let's subtract that from where the market is. And now let's put it just into sort of a pip format. And when we do that, what we're going to see, this is the easy thing. If you'll learn to do this little easy trick right here, okay, you'll see whether or not it's far enough. Notice how what I did was I simply said, okay, what is my one-to-one take profit price on the bot spread? What is my one-to-one take profit price on the short spread? What's the difference between the market and where that is? Between where the pound dollar is right now, the actual spot, and where that take profit price is. And notice it's a 40 pip difference. It's a 32 pip difference, but I only have a 30 pip take profit. Okay? So when you start putting those pieces together and realizing, oh, wait a minute, I need to take, if I only expect 30 pips, that's too expensive. So either I need to find another spread, choose a shorter time frame, look at inverting the trade to an iron condor if it's way too expensive, which I do a lot. You'll see, like I did that on NFP, I did that on FOMC the last couple times. We should put some of the trades on the air. Or I need to look at strangles, and if nothing lines up, if iron condors aren't working out, if strangles aren't working out, if straddles aren't working out, if other instruments that I have available with expected stats aren't working out, then I need to back off the trade and just, this isn't my trade. But it's not like it just has to, like, if that doesn't work, it's not it. There's other expirations, other instruments, other strategies, strangles, or, inverting it if it's too expensive. So I have a few choices, but I need to know that this is not the right choice, and I have one trader who he likes to trade larger sizes. This is one of his big things he does. And, he says he's profitable enough to do this consistently, and he goes in and he goes for half. So he's actually not trying to make, like, if he has a $18 risk, he's trying to make $9. Now, usually the risk is more like 40 or something, but he's just trying to make half that profit. And so with him, he's easily inside the range a large majority of the time. It hits it, boom, he's done, he's out, he moves on. But the biggest mistake traders will make is they'll go in and they'll set that take profit up here at 64.96, which is 10 pips higher than we expect it to go. And that's exactly what happened to the trader who did the NFP report the other day on the euro dollar. Now, he also chose the 3 o'clock. He could have chose like an 11. There's a lot of different things that could have been done differently. But bottom line is he had a trade that had to move 130 pips on a 100 pip expected move. So, obviously, the reason that, not only was that not good, but it only moved like 80 pips. So, it didn't even move the full 100. He was able to get out of the trade, by the way, pretty much, I think he made literally like $1.50. So, but, so pretty much break even on the trade. But, per straddle or whatever. But, if you'll pay attention to this, it'll save you a lot of headache because so many people do that. So, I'm going to go over that just one more time for you. The simple way to figure out what it is 1, figure out what your one-to-one take profit price is on your bought and your sold. Okay? So what price will I sell back my bought? What price will I buy back my sold? 2, figure out how far that is from the underlying market, where it is at that moment that you get in. Okay? So in this case, that take profit price is 40 pips higher, or 30 pips lower, or 130 pips higher. Who knows? Okay? 3, is that difference between where you got to take profit and where the market is greater than the expected move for that news announcement? If the answer is yes, then you have several choices. 1, go for less profit, which messes up your risk-reward ratio. 2, check for other expirations or instruments that you have expected ranges on. 3, look at potentially, if it's too expensive, doing the opposite, okay, which is a bit more advanced. 4, look at strangles, okay, and then 5, set aside, okay, and demo trade it and watch what happens. But if you'll take that, you'll go back, re-listen to this, and just make sure you got that one little tip down there of what's the difference and is it higher, then it'll make the whole world of difference in your trading. Okay? All right, well, that was the big thing I wanted to get across today for you on the news trades. It's not a big news week, but I want you to use that to your advantage if you are a Nadex trader. I want you to hop in and just start going, okay, if I did a straddle right now, what do I think, would happen on this trade? How could I take advantage of this? So I just, if you'll start doing this and you'll start just calculating, what would that be? And then, okay, then all you have to know is what's the expected range. It makes it real easy. If I know the expected range, then I can see if it's too big or not. And then I go, okay, well, if it is or isn't, then how do I switch over to looking at, potentially something else that might work, better for me? And let's see here. Let's go in. And so I have, I built an expected rate every single hour of how far I expect. I have every day. I have every hour. I'm working on 2 hour, 5 hour, 7 hour. I'm also working on 2 for 1 week. So, but my deviations are for a day. These are for an hour. And so, just looking at expectations. So I could go in and I could go, okay, well, I expect there to be a 14 pip move in this hour. All right, that's what I expected. You can see right here, the current hour, sort of going off the screen there. Let's see here. The current hour, the expected move was 14 pips. We're actually at 14 pips right now with 12 minutes to go. Okay, high to low. And it may exceed that, but, that's the most I really expect out of the hour. Okay? And so I could go in here, and we were looking at this. This was at 3 o'clock. Remember it? Or was that? Yeah, it was at 3 o'clock. So that's actually 2 hours worth. But I could go in and go, well, if my expected move is 14 pips, then what would I need to make? What is the risk? And so you could go over, you could look at the analyzer. And you obviously would have looked at, this is a little bit different, but and we might walk through this tomorrow and sort of do this, do a straddle, and just right on the hour as an example to go through, just walk through it, just to really nail this down. But I can get rid of this time here. But, right there, $3 and for 2 o'clock, and what is this? $26. Obviously, that's not going to work. So just knowing those ranges, helps out so much. But making sure you are correctly calculating pound to take profit versus just spread to take profit and assuming they're the same thing. All right, we'll be right back after this break.
You take a hands-on approach to managing your investments. And whether you're bullish or bearish on U.S. Treasuries, the ETFs from Direction Shares are there to help you magnify your perspective. Bull ETFs for a rising market and bear ETFs for a falling market. Direction Shares gives you the tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor Foreside Fund Services, LLC.